Hi, welcome to my channel. This is Dennis Lee, and today we're talking about the Singapore savings bonds. So what are the Singapore saving bonds? It's a type of bond, and normally when you buy a bond, you lend money to the issuer, but in this case, the issuer is the Singapore government. So what are the returns like? Well, the returns are above 2%. However, each year it steps up. So the longer you hold a bond up to the maturity date, which is 10 years, you will have a higher interest rate each year. And you can check the monthly bond rate at the Singapore Saving Bonds official website, which is www.sgs.gov.sg. So why should I buy the Singapore Savings Bond? Well, compared to stocks, there is virtually no risk as it's backed by the government, whereas in the stock market you could potentially lose all your money. Secondly, it pays a regular coupon, whereas for stocks you may or may not get dividends depending on the management and how the company performs. The third, there is no volatility, and basically at the end of the maturity you get back all your capital. Whereas for stocks, there is a lot of volatility, and during the bear market, you could be below your cost if you do sell it. Why should you buy SSB instead of other bonds? Well, the minimum requirement for purchasing SSB is around only $500, whereas for other bonds, it may be in the hundreds of thousands. And why should you buy SSB instead of putting your money in the fixed deposit? Well, SSB pays a higher interest rate than a fixed deposit at more than 2%, whereas for a fixed deposit, you'll be getting between 1 to 2% per annum. Secondly, for fixed deposit, there might be a penalty if you redeem early. Or you may have to forfeit your interest. Whereas for SSB, there is no early redemption fee or penalty. Just to recap, the advantages of buying Singapore saving bonds is, first, there is no lock-in period, so it's up to you to decide how long you want to invest your money for. Secondly, there is a high liquidity, which means you will not be penalized for withdrawals or early redemption. Third, there is a low risk or virtually zero risk because it is issued by the Singapore government. Fourth, you get regular payouts at every 6 months, and the interest does go up slightly every year on a step-up basis until you reach the maturity at the end of 10 years. And fifth, there is a low starting cost because you only need $500 to start buying the SSB. Well, the negative side is that, well, the returns may not be comparable to, stock markets, etc. And also there's a $200,000 cap for the amount that you can put into the Singapore saving bonds. And that's all for today. And if you like this video, please click on the like button, and thank you for subscribing.